Good evening, traders. I'm Himalay Bhatia from the Financial Analyst, and I welcome you to the Bold Project. In this module, we have been discussing about the Dow theory, and we have already covered the first principle, that is the stock market discounts all information. The second principle, that is the stock market has three trends, and the third principle, that is the primary trend itself has three phases in it. All right, now let's talk about the fourth principle. Now, before I get into the details of it, let me tell you one thing over here. The fourth principle is a little outdated. However, what I have done is I have modified this principle as per our current needs. But before I get into the modification part or the modified part, what I will do is I will be explaining to you why this principle was developed so that we are able to correlate what was happening back then and what are we doing right now. And that will really help us increase our accuracy in the market. All right, so let's get started with the fourth principle. The fourth principle says that the stock market index must confirm each other. Now, what does this mean? So, about 150 years back in the US, what they used to do is they used to compare the industrial index with the rail index. Now, why they used to do this is because it's basic economics, all right? Now, let's say that, generally the factories are located in the outskirts, and the main mode of transportation or the commercial transportation about 100 years back was nothing but your railways, correct? So what they used to check is if the production in the factories is increasing, so should my consumption for my railways also increase? Why? Because to transfer the goods from your factories within the country, the only mode or the main mode of transportation was the railways. So if my production is increasing, so should my consumption for my railways also increase, or vice versa. However, if my production is increasing but my consumption for my railways is constant or it is declining, that means something is not right in the market. Something is fishy, and such sort of contradiction is known as a divergence in the market. All right. Now, divergence, the meaning of it is nothing but contradiction. All right. And in this case, we need to understand that divergence is something which is not a positive signal for a trader. It is rather acting as a warning signal for the trader. However, in few cases, in your few indicators, you will learn that divergence is something which can act in favor of the trader as well. So those things will be covered in the indicators topic. All right, let's talk about how I have modified this as per our current needs. So again, what I have on chart is my HDFC Bank, right? And what we will do is, since HDFC Bank is a part of the banking sector, let's look at the um, let's look at the sector over here. All right, we have HDFC Bank, and what we will do is we will click on the symbol over here, the compare symbol, and we will compare it with our bank Nifty, with its sector itself. So what am I trying to do is, I am seeing that if the sector is in demand, so should my stock also be in demand, correct? And if my sector is not in demand and my stock is also not in demand, so that really does not matter. As long as the stock is going hand in hand with the sector, it really does not matter. Such sort of a scenario is known as a convergence in the market. I hope that is clear to you all. So let's take an example over here. In this period, what is happening is there is a demand in the sector. The purple line represents the sector, the candles represent the stock. We should not be bothered about the percentages over here. Am I clear? So let's look at the sector over here. There is demand in the sector, and if there is demand in the sector, so should there be a demand in my stock. And there was a demand in my stock as well for the same period. All right. Now let's take this period. In this period, there was no demand in the sector at all. The demand in the sector was declining, and so the demand in the stock was also declining. That means there is nothing wrong with this stock and we are free to trade in this stock. However, let's take a particular example of divergence. All right. So for that, what I will be doing is I will be opening up Mindtree. Now, Mindtree is an IT related stock, and Mindtree has about 1.58% weightage in your Nifty IT. So these sectorial distribution, you can get it on your website named niftyindices.com, and you can get this distribution for all the sectors. All right, so let's take a look at Mindtree. Now comparing my IT stock with my banking sector won't make too much sense to me. So what I will do is I will rather compare it with my Nifty IT. All right. Now let's see what is happening over here. In this period, there was demand in the sector, so was there demand in the stock. All right. So again, there was no problem in the stock over here. Now let's pick out a particular point in time wherein there was some sort of a divergence in the stock. Now what is happening is there is demand in the sector, but for the same period, there is a lack of demand in the stock. That means your stock is not going hand in hand with your sector. And this concept is very beneficial to us is because let's say that we are in the current period over here and we have zero information and zero news about the company. Just looking at the chart, I will be able to predict or I will be able to say that something is wrong with the stock, and what I will do is I will avoid taking trades in such situations. All right. Now let me show you a surprising picture over here. Let's take up this period. There was a lack of demand in the sector, but for the same period, there was demand in the stock. Now people tend to ask me, what should we do in such cases when there is no demand in the sector, but there is demand in the stock? So what I advise them is, it depends on the type of of trader you are. If you are a person who is a risk seeker in the market, then they are free to enter in such trades. But if you are a conservative person, and I also advise everyone to be a little conservative in the markets, right? And you will understand why, because there's one point being covered in this theory. Anyway, let's take a look at this point. If you're a conservative trader, then I suggest to still avoid such situations. Now, why do I say that? Is because, again, this is just basic economics. A company cannot outperform the benchmark for quite a long period of time. And the period for which it outperforms the benchmark is considered as the supernormal profits for that company. But in this case, what is happening is, and after some time, what can happen is the company will start respecting the benchmark. And so is the case over here. What can happen is there is a lack of demand in the sector, but there is demand in the stock. What can happen is the prices are moving up, and at any given point in time, the stock can immediately start respecting the sector and it will crash down, thereby making huge losses for the trader. That is why I suggest all the clients to avoid such scenarios. Let's take the next example as well. Again, the same thing. There was demand in the sector, but there was lack of demand in the stock. Now, this period was around your, forceful acquisition of this company, and thus there was extreme volatility in this company. All right. Let's take one more example over here. Let's talk about Maruti. It is an auto company, and what we will do is comparing my auto company with my Nifty IT won't make sense to me. So what I will do is I will compare my Maruti stock with my Nifty auto. All right. And what I have to see is if there is any divergence or not. So for that, let's do one thing. Let's first check the weight of Maruti in your Nifty auto. So Maruti holds about 24.05%. And this data is as on the last trading day of the previous month. All right. So this may keep changing a little. And I've already mentioned the website. You can go check it on your monthly basis. Now, since Maruti is holding maximum weightage in this sector, so it is pretty understood that the sector will be slightly skewed towards this stock, and spotting divergence in such stocks will be very difficult, or there will be no scenarios of divergences in such stocks. All right, so you can look at the charts for yourself. There is demand in this sector, so is there demand in the stock. There is lack of demand in the sector, and so there is lack of demand in the stock. Just because this stock holds a lot of weightage, that is around 24% to 25%, and it is pretty obvious that the sector or the Nifty auto will be slightly skewed towards this stock. All right. So what we'll do is we will take one more example over here from Nifty auto. That is your MRF tires. So MRF is also a company which falls under the Nifty auto. All right, I have seemed to close that page over here. All right, we have it. So MRF constitutes about 3.67% weightage of your Nifty auto. So that is what is happening over here, is that the sector is not too skewed towards the stock, and thus there is a higher probability of a divergence in the stock. So let's take a look at the sector. This picture is clearly showing me that there has been demand in the sector, but for the same period, there is a lack of demand in my stock. And what will I do is I will avoid taking a trade, be it your intraday trading, be it your swing trading. I will avoid taking trade in such stocks. All right. So we will be filtering out these stocks, and there are tons of other opportunities. There are tons of other stocks. So what I suggest people is rather focus on something which is less riskier. There is already market risk. There's already company risk. There are many other risks attached to the stock markets. Why take additional risk over here until and unless you're a risk seeker? I hope that clears your point. All right, so this was all about the fourth principle and its application. In the next episode, we will be talking about the fifth principle. In case of any doubts, please note it down and we will take it up on the weekends in your doubt clearing sessions. Thank you.